The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
When it comes to ambiguity bias, it's important to keep in mind the key principle that drives almost every investment decision that we make, and that is that certainty and return have an inverse relationship, so that the more we have of one, the less we can expect to have of the other. And that trade-off is particularly important as you listen to this podcast to keep in mind about ambiguity bias.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
Hello, everybody. Welcome to another episode of Fix It Friday. We're recording this one just about a week and a half or so before the end of summer, and it went by quickly, but hopefully you'll enjoy today's episode. Today, I want to talk about something called the ambiguity bias, and it's a bias that drives our financial decisions in such a way so that because we're seeking investment choices and options that have more certainty attached to the cash flows that they provide, and more certainty with regard to the level of fluctuation we can expect from them. We're attracted to those types of investments. So a good example of that is bonds. We're attracted to bonds because, in general, bonds pay interest periodically, usually every 6 months, and there's not too much ambiguity. We know at the end of the maturity of the bond, when we get our money paid back, if we invest $1 million in a bond, we loan a company $1 million. At the end of 5 years, when the bond is due, they owe us our $1 million back. We know we can't make more than that $1 million, and we make whatever the interest rate is in between year 1 and year 5 at maturity. And there's a comfort level just knowing that we're going to get that money. So a lot of people will bias their investments toward things like bonds because of the ambiguity bias. So the paradox of wealth management is that when it comes to ambiguity bias, the more we emphasize certainty as it relates to the need for certainty and the cash flows and the returns we get, the more we increase the probability that we'll fail to meet our long-term financial goals. So how does that happen? One of the things that we need to do before I talk about how it happens is to define the difference between risk and ambiguity. So risk involves calculable odds of events occurring based on their historical record. So, for example, we know that if we invest in the S&P 500 or in stocks broadly, as a general rule, for the last 100 years, there have been about 75% of the single year, 12-month periods have been positive. And when you go to 3-year and 5-year rolling periods, you have 85% that were positive for 3 years and almost 90% for 5-year periods. So when we look at the risk of investing in stocks, once we extend the time horizon past a year, the odds of succeeding grow very close to 90% in 5 years and close to 95% in 10 years. And there's never been a 20-year rolling period where stocks have lost money. So when we look at the returns that have been available for the last 100 years after inflation for investors by investing in the stock market, could be again defined here by the S&P 500, the returns after inflation have been 7% a year. Investing in a portfolio of similar companies, bonds, right, to those companies that are in the S&P 500, the after inflation returns for the last 100 years have been 3%. So 7% after inflation for stocks, 3% after inflation for bonds. And so we ask ourselves, knowing that long history, why would rational investors choose to have any meaningful portion of the money that they invest in the investment class bonds that earns fully less than half of what stocks have earned after inflation? And the answer is, in many cases, it has to do with the ambiguity involved with investing in stocks. The 10% a year comes with a decline of about 15% every year on average since 1980. And it comes with a decline of about twice that amount, 33%, 1 year in 5 or 6. But we can't know with certainty in the short run when those declines will happen. So, for example, during COVID, when the economy shut down, the market declined 34% from February 2020 to March of 2020. So in 1 month, we had an unprecedented 34% decline. There's nowhere that we can look for guidance to have expected that might happen in history. It's just part of ambiguity, right? We just couldn't forecast. Okay, well, a good way to look at ambiguity. Ambiguity is what's involved with the short run decisions, right? What's going to happen in the next month, year and a half? Anything can happen. But risk and analysis of risk and the history of risk is what we look at over long term. And we're investing for the long term. So what is one to do to fight the ambiguity bias that we have and prevent it from causing us to make very poor long-term financial decisions? So what we really need to do is look at our needs, look at the risk and return expectations involved, as opposed to looking at whether or not an investment outcome is more or less ambiguous, right? Because that doesn't help us in the long run. We need to make sure that we fight inflation and that we have enough spending 10 years, 20 years, 30 years down the road. We need to choose the investments that are more ambiguous than less ambiguous. So let's take a look at a real life example. A lot of retirees who are revisiting their investment plan like to make sure that the stocks that they own have higher dividends than lower dividends, because there's less ambiguity involved if you're starting off with a stock, let's say, with a 4% dividend cash flow than with a stock with a 1% dividend cash flow. In your mind, you're saying, well, I'm getting 4 times the cash flow. That's really nice. I like that perceived certainty. But when you now unpack the baggage, let's take a look at it. If you look at the fact that total returns include dividends plus growth, and you recognize that why does one company pay a much higher dividend, let's say, than the average company in the S&P 500? And the reason is generally because that company who's paying the higher dividend is not growing their company or their business as fast as the other companies. So the CEOs of that company, the people in charge of making sure they maximize shareholder value, say, gee, I'm just going to pay out more of my cash flow in the form of dividends because my business isn't growing fast enough to warrant investing more money in it. And so why would one want to own a business that's not growing fast enough so that the appreciation of the asset, the stock, won't be there? And the reason is they feel more secure that they know there's more cash flow in that higher dividend. But when you think about it realistically, you actually want to own the companies that are growing fast enough to warrant investing and reinvesting the money in the company's growth, because that growth is going to be so far superior to the company who isn't growing that the total return, the lower dividend plus the higher growth, is going to lead to a higher financial and a better financial outcome. So that's just a real life example that we see. And the other example, of course, is the basic one where people will prefer to have more bonds than they need in the portfolio than stocks, just simply because of the need that they feel to reduce ambiguity. So one of the things I like to tell people is it's very difficult to invest to satisfy our emotional wants, the need to not have a lot of movement or volatility in our portfolio, versus investing for our financial needs, the needs to maximize our ability to have the income we need in retirement and leave a legacy behind. So we need to decide on which end of our financial life we're willing to have more uncertainty so that we may have more certainty on the other end. And so those who are not willing to put up with ambiguity in their earlier years, or even when someone's 70 and have, God willing, another 20 years to live off of their money, if they're not willing to put up with the ambiguity in the first part of that 20-year period, or if you're retiring the first part of the 30-year retirement period, then you have to put up with the uncertainty later on that you may have to reduce your lifestyle or run out of money. And that's the trade-off for choosing less ambiguous investments that are also likely lower returning investments in the short run. And so just be aware of the ambiguity bias, focus more on risk and return. Where there are probabilities, recognize that as a long-term investor, you can calculate the probabilities and determine whether or not that's appropriate for you, meaning that if stocks return 7% a year over long periods of time after inflation and bonds return 3%, and if stocks for 1 year periods go up 75% of the time historically, and for 5 year periods, almost 90% of the time. So, gee, I can live with that. I don't mind the short-term ambiguity, and I certainly don't want to trade in choosing less ambiguous investments that will lead to a very low probability of me hitting the financial goals that are so important to me and my family. In closing, I want to remind everybody about the key principle that's involved with every investment decision, and we started off this podcast focusing on this as well. And that is that certainty and return have an inverse relationship, so that the more we have of one, the less we can expect to have of the other. So when making investment decisions that could be derailed by ambiguity bias, please keep that principle in mind. And not only with that, but with every investment decision that you're faced with going forward. You can catch us on your favorite podcast channels, and you can always get us on fusionfamilywealth.com and crazywealthypodcast.com. Wishing everybody a happy fall. See you next time.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.